Greetings, Dr. Jeffrey Scott. This is my weekend market update for July 31st, 2022, although I may post it late in the day on the 30th. My email address is hgsidoc@gmail.com, and I titled this edition, Are Markets Ready for a Pause? And I'll show you data to support that. If you're new to the channel and would like to get notified of when I do these videos, click subscribe and then the alarm. And I always welcome comments either in the remarks or just the thumbs up, thumbs down. Nice to know people are watching. Disclaimer, this is for education purposes only. Anything I recommend is the spirit of education, is not investment advice. I am a doctor, not a broker. Any tools I demonstrate are those I use in my daily trading. I've paid for those tools, and trading involves risk, and you alone are solely responsible for any decisions that you make. All right, now I like to start where I combine very quickly some views from different programs to give you a sense of what I'm seeing in the market. So these are some spreadsheets taking out of HGSI, and I've ranked, the top one is some of the major market indices, and the bottom one are the S&P sectors, and I've ranked them by current change off of 52-week high. So the first thing that comes out and strikes you, or should strike you, is that we're 73% off on Bitcoin even after the recent rally, 64% on ARK Innovation, and the things that have held up the best have been the dollar. Now, big caps, whether it's the Dow, the NYSE, or the Spiders, are outperforming the small caps, the Qs, the Russell 2000, almost by a 2-to-1 margin. And things like biotech, FANG, and the IBD 50 ETF have all sold off hard. Now, if we look at the week that was, you could see lots of green. The weak things on the week that was were the dollar, bonds, and ARK Innovation, probably because of Roku or earnings, perhaps. And the rest of the market was strong, and you could see returns as high as 9% on silver. Big move there, 4.3 on the week on the S&P. Commodities were up 4.6. Natural gas was up 1.1. And then even biotech, FANG, and the IBD 50, led by the IBD 50, up 6%. A lot of strength. I'll show you some evidence that we have rotation into growth as we go through here. And if one looks at Friday, Friday just carried on what the week was doing. If you look at the changes since the 52-week lows, what I just want to point out is that in 43 trading days, since the June lows, the NASDAQ is up 17.3%. The Qs are up 17. The Russell's up 15. The Spiders are up 14. The NYSE is up 9.6, and the Dow's up 11. So bear market rallies, when they occur, and this is still in my mind a bear market rally, can go a long way. Heck, we're almost at a new bull market, I guess, if you just look at the NASDAQ, 17% off the June lows. It's a bear market rally, folks. It may be the beginning of a new bull, but let's see how far this one goes. I think we have some evidence that it might slow down, at least pause to refresh. If we look at the S&P 500 from a sector perspective, you can see utilities, healthcare, and staples are all down less than 10%. And energy, which was the big leader, is down 16%, so it's actually moved up. In fact, it's 73% off of its 52-week low, which occurred, wow, almost a year ago. If we look at the Q Edge tool, get a sense of what's going on in the market, there's like three messages here. Number one, 33% of the stocks in the S&P 1500 traded above their Bollinger Band. That's extended. 84% are above their midline. 91% of sectors were up, 77% of industry groups, 74% of stocks. Every sector except defensive utilities was up. And if we look back, whether we're looking at 1 month, 2 weeks, 1 week, 2 days, or 1 day, there are very bullish green pies for industries, sectors, and stocks. The warehouse report, where I take the fundamentals from a week ago and ask, how did they impact on performance over this week? Using the performance to the 23rd and the 29th. And what do you see when you see a lower left to upper right? That tells you growth was in style. And look at the returns here, up to an 8% and exceeding 8%. When you look at performance compared to EPS rank, performance compared to relative strength rank, it was truly a good week to be in growth, and the leading groups had the best of the returns. When box 7 over here is doing well, that's a turnaround, and I think we saw a turnaround. Take a look at Amazon, some of the chips, and how they performed this week. If we look at the NASDAQ, and this is just a spreadsheet I keep looking for the proverbial Hindenburg-Omen, which we'll talk more about when we have to worry about them when we get to new highs. But there's a lot of information here. One thing is we're still seeing a lot of new lows and no new highs on the NASDAQ. So we're not out of the woods until we start to actually see some stocks moving up and getting close to highs. We're nowhere close on the NASDAQ. But the NASDAQ bongo has now been green. We talked a lot about the bongo on my training session today for the marketplace package. And, you know, there's a lot to like here. And maybe even I want to believe that this market has a lot more to go. But I think we are at a point where pause is potential. The NYSE also had some new lows on Tuesday, but it's got relatively few new lows or new highs. And it did turn bongo green weekly on Friday, which is also bullish. The buckets, we just saw this on the Q-Edge tool. Just want to show you how this market has rotated. Back at the June lows, we had 96% of the stocks were below the midline of their Bollinger Bands. Now 87% are above. Back near the June lows, 20% of the stocks were below the Bollinger Bands. Now they're very few, yet 30%, 35% are above. So we have gone from an oversold to an overbought market. Part of what I said, perhaps a pause might be in the cards. And if we look at a week ago, you could see the stocks above the midline have gone up, but the big difference is the number of stocks that are above the Bollinger Bands. If we look at energy performance on the week, actually pretty green. Coal was the one laggard. Coal's had just an amazing year. Look at some of the coal stocks. But Brent was up big, much more than the U.S. crude. So I wonder how much of that has got to do with Ukraine. Gasoline was up big on the week, and you could see some of the refiners like MPC started to improve. Gas in Europe, because I think reductions in the amount of gas that Russia can pump, because of some mechanical issues they alleged with their big pipelines, was also up a lot. When I look at metals on the week, and again, what's the driver here? It's probably the weak dollar that we're going to talk about. All of these would benefit from a weak dollar, especially gold and silver, which on the week were up 2.5 or 2.25 on gold, 9% on silver. Copper, steel, iron ore all saw big improvements on the week. One thing that's concerning, I guess, if you own a lot of dry bulk shippers, but perhaps optimistic if we're thinking about inflation, is how much the Baltic Dry Index, how much does it cost to ship on the spot market dry, goods from China or other places. With this really coming down to near the 2022 lows, does that mean that the supply chain interruptions are better? That would be great for inflation. Speaking of interest rates and inflation, didn't the Fed raise on Wednesday? I'm scratching my head because look what happened to rates. Rates have come down significantly. What that tells me is that, especially on the long-term rates, I think folks are expecting that inflation is going to abate and the economy is slowing down and the Fed might not be able to do all the rate hikes it anticipated. On the credit spread, it's still very elevated, the risk, the credit risk. And we could see in the past, whether we look at this chart here showing what happened in 18 when the risk spiked. I think we all know what happened in 2020 when the risk spiked. Well, the risk has spiked here as well, and that's not good. The other thing that's interesting is the yield curve inversion. On the 10-year, it's really deep. What does that mean? Is that because of the element of QE and how much liquidity was put in with COVID? Is it because we had no interest forever? Is it because of the concern that there's a big slowdown coming in the market and so the longer term rates are not keeping up with the short term rates? which are probably more controlled by the Fed. I think there's a lot of reasons, but it's concerning. Overbought, oversold. Why did I say we might be looking towards a bounce? Because if we look at stocks above the 200, stocks above the 40, we've had massive increases. The stocks above the 40 are trending towards areas that you might see a reversal. If we look at the T2121, the 13-week new high, new low, it's getting very close to a reversal point. And I guess if I want to be optimistic, we've been dealing with McClellan oscillator divergences on the weekly S&P 500 for ages. And if we just continue to increase here and get above, could we be in a bullish convergence? We'll see. That would be good for the market. We'll see. News this week. It's anytime you got the monthly unemployment, non-farm payrolls, jobless claims, it's a big week. The other thing to point out in green, you've got on Tuesday and Thursday, you've got Fed presidents speaking. Earnings, last week I called earnings Lollapalooza. This is earnings Lollapalooza redux. Lots of stocks in multiple different industry groups. As I've said before, it is a judgment call to hold stocks over earnings. It's bad judgment if you don't know when your earnings date is. Expected move chart. This is another thing that's just crazy right now. And this is if you buy a straddle at the money, which means you're buying a call and buying a put, which means you're paying for two premiums and you're betting that you get an outsized move. The problem is over long periods of time, 80% of the time you stay within the expected move, which means you don't make money. So what's crazy? Let's look at the spiders. We opened the week where we closed the prior week, didn't do much on Monday. Tuesday was a negative day. Wednesday, a big bullish reversal. Thursday, we went outside the mood, and Friday, we went further. So we are way outside. Now let's go back and look at weeks. 1 week to the upside, 2 weeks to the upside, 1 week to the downside. So that's 3 weeks outside. 3 out of 4, this one was in the range. 4 out of 5, this one's out of the range. 5 out of 6, this is out of the range. 6 out of 7 is out of the range. 7 out of 8 is out of the range. This one is in, so that's 7 out of 9. This one is out, so 8 out of 10. So if we go back 10 weeks, 8 out of 10 times we finished above or below the expected move when 80% of the time we're supposed to stay within it. This market is nuts. Nuts. It just shows you the volatility that you're dealing with. NASDAQ also above the expected move, as was the YM, as was the Russell. So let's think about what this means. The smartest money in the market has determined what the expected move is, and they're the ones that are selling you the straddle. So the options market makers, they're the smartest money. They're setting the price to win because the odds are 80% over a long period of time, they're going to win. Yet in the last 10 weeks, they've lost 80% of the time. Who's the expert? I don't know. The VIX stayed within, the dollar stayed within. I just think it's amazing how much it's moving. So what are my thoughts? Markets had a huge week despite news and earnings flow. Lots of potential reasons. Short squeeze, belief that inflation is slowing, perhaps a desire to add long exposure, maybe going into the third quarter. Lots of market rotation at both the macro and micro level. Growth improved as did small caps. Healthcare and staples cool, but technology, discretion, industrials perked up. My simple market timing is very close to flipping to a buy as we've nibbled above the 30-week WMA on the weekly ETFs, and the weekly bongos turned green, so I've increased my exposure on the long side. The bearish argument can be made that really short-term overbought and approaching levels that usually signal at least a pause. I'm talking specifically about those buckets. From a potential volatility perspective, we have the monthly employment report on Friday and 2 Fed heads and lots of earnings. So as noted, I have deployed, and when I say as noted on my nightly videos on stocksanddocs.com, I've noted that I've deployed more cash, but I'm going to let the market play out before I deploy much more. Have we bottomed? Nobody knows for sure. Lots of people have said we bottomed. Maybe we have. To me, the market is not an all in or out phenomenon. It's about risk management. As the market gets stronger, I deploy more of my cash. As the risk increases, I raise cash. I would rather miss some of the new bull than have my portfolio whacked by what could be another leg down. So that's my view of the markets from a high level. Now let's do it from more of a charting perspective. This here is Wealth Charts. Wealth Charts is a platform that I've started using over the last year or so, and they've incorporated a lot of the things that I like to do for me, and to me it's made it simpler. I don't have to update, it's automatically. There's a lot of things I like. It's also a real-time platform, although for my style of trading, that may not be the most important thing. Let's start by looking at the major indices, and I'll make the case of why I think we could be at a point to pause. Here are the June highs. Here are the June lows. Here was the low on June 17th. I think the buckets lows was that Friday, because I do it on the weekend. I wonder if the 17th wasn't a Monday. Let's see if this is the, nope, 17th was, nope, 17th was the Friday. Maybe it was the 17th I ran them. Whatever. Why did I set this as my target? Because it was resistance back here in early June, and it was support back here in March, and it was kind of a fulcrum that we went above and below in May. I think this is an important price point. We are not far from it, and in my mind, we probably, there's probably three roads that can happen here. Go back to my mentor Ian's way of looking at life. High road, we go right through. Now, it probably doesn't look like that. It probably looks more like this. That is the bullish scenario. The bearish scenario is we get close and then we break down and retest down here. And boy, will this be an important retest. What I think the most likely thing is we probably run up and then we probably do this. And then if I'm bullish, I hope we do that. So scenario 1, scenario 2, scenario 3. So in my mind, I have to be prepared for each of those three scenarios. I think this is an important line, considering where the buckets are, how we ran up the last couple of weeks. A pause to refresh, not much different than what we did when we took out the 50, would actually be bullish. Now, the good news is we did take out the 50. The daily and the weekly bongos are green. We're doing it on decent volume. And when I look back at the Qs, which are a little bit different, they've already hit that line. And if you look at the current channel, they're also at the high of the channel. So perhaps the Qs are even more likely to pause to refresh. And let's just think about this. Again, go freehand. If I just pull back to the bottom of this, and then I bounce, we got a higher low again. That's okay. So again, I'm not thinking long term when I say we might have some risk here. I'm thinking short term pullback, sideways movement, not necessarily a retest of the June lows. If I look at the NASDAQ, the diamonds and the Russell, they look more like the spiders where they have not hit that target. The VXX has sold off with the VIX, and the dollar, which is probably why we're seeing so much strength on the commodity side, has eased. Speaking of commodities, both gold and silver are starting to have some trending moves up. Now, they've got major amounts of overhead supply. They got to get beyond the 50. But if the Fed's done tightening and the dollar's done going up, I expect to see an opportunity in gold and silver. Clearly this week, with the big gap up in silver, there already was that opportunity. Oil, and not as simple, it broke down below the 50, did not trade all the way down to the 200 before reversing. Still has to get above the 50. We're starting to get in less seasonally strong period of time for energy and oil. And natural gas was kind of like they read David Elliott's book on an ice hole failure, broke the 50, failed on the retest, and therefore should trade down to the 200, which it did, in which case it bounced, and it's now retraced almost everything that it lost. Again, natural gas is probably being whipped around by the geopolitics of the current world. And if we look at the TNX on the daily chart, not only has the dollar sold off, but look at the fake out back here where it traded up, closed down, and it's been in a downtrend. This is a daily chart on the TNX. Now, one thing that I was reminded this week is somebody called out that, should get that into a weekly or not? That's not going to go. That when rates are falling, it's good for growth. And if you look here of a spider value versus spider growth, up top would favor value, down low would favor growth. We're seeing some growth. And while the rates have been going up, it favored value. You could also look at that in my market theme charts, where if I look at the hourly chart, we're now favoring small caps and growth. On the longer time frames, looking at the daily, you can see we've been living up, whoops, hit the wrong one, I'm sorry. We've been living up here, which is large cap and value. That's the high level macro sector rotation I'm seeing. Now I mentioned my simple market timing system. It's simple because it's easy. It's market timing, and it's not anything fancy about the name. I look at two things. I look at price versus the 30 period WMA. It's a weekly chart. And I look at the presence or absence of a green weekly bongo. I've got green shoots of improvement here. I've got a breakout above the 30. I've got a bongo. This is why I deployed more cash. The NASDAQ and IWM fired on this a week ago. And had it at the close. The spiders and the Qs intra-week look like they might, the spiders and the Dow, but they ended up closing with the red bongo. If I look at the S&P 500 sectors to get a sense of where the short term the money was rolling, my 3 stars for the weekend are industrials, technology, and discretionary. Obviously, discretionary is very heavy weighted towards Amazon, and they had a great move on Amazon off of earnings. Some of the recent leaders like Staples, utilities, healthcare, and real estate have weakened some compared to where they were, although some of the stocks are still performing fine. If I go into my scanner, and I've already built my watch list, the heat map starts by showing me where the strength was. And okay, so this is funny. Because some platforms do this and some do it the opposite. If we look at Amazon, Amazon had a massive day on Friday, and it was up 10.36%. Here it looks like it was down 1.7. What does this tell you? It tells you that this program goes off of the after hours close on when the stock jumped on the earnings, and not from the open today to the close. And the stock did jump on earnings after hours on Thursday. Tesla, Microsoft, Nvidia, Google. Another one that jumped after hour on earnings are Apple. So this is an anomaly because they should be very green as well. On sector scanner, let me just return to sector. You can look at the individual sectors, and one thing you could see is Staples and healthcare. As we went into the end of the week, they weakened. If we look at the entire week, cyclical, which is discretionary, actually on the week was weak, but it had, you look at the algo on the daily is much stronger than the algo on the weekly. This is one that's improving. I'm challenged sometimes by the percentage changes, which is why I like the algo score, because there's a lot of junk in these lists. This is not the S&P 500 or the 1500. Hey, I'm part to blame because I wanted to have more stocks, but we got 2100 industrials, 1000 technology, so there's a lot of thinly traded names in there. But I'm interested in technology, industrials, and discretionary. That's what looked interesting. If I go into Wealth Scanner, what's showing some strength? Looking at the top-down indices, healthcare, home builders, that's kind of interesting. And I thought about it, why would home builders be doing well here? I know down here we're seeing prices on homes in Florida start to moderate a bit. And I think they're doing well here because their cost of building is down because wood and copper and all the commodities have come down. So home builders, despite rising rates, actually doing okay. Tan, solar, really doing well. It's probably run too much. Here's another home builder ETF. So you can get a sense by looking at the top numbers. You drop down to 500 here and below. So I don't usually like going below the 6 or 7 or 800s, but you can see some interest in home building, solar, munis, and then still some healthcare, which is interesting. I think next week we're going to see that one come down unless the market changes. And I think it too is geopolitical. There was a reconciliation bill coming out of Washington that will look at controlling drug prices. I guess I'll keep my nasty comments to myself. And no, I'm not in the camp that says the government should stay out. I'm in the camp that says they need to, but they've never been able to, and they need to do it fairly. So I'll just stay out of it beyond that. The combos leader list is a list of strong technical and fundamental stocks that I put together. It's about 600. I look at it as sort of my Scot 600 to look at. So I do a lot of my prospecting there. Since I build a tops down list as well, let's go look at my weekend review list. And so the weekend review list is a list of stocks that are in the top industry groups, in the top sectors, plus it's some of the stocks from that my 600. And then I use a filter, and I'm bullish, so I'm going to stay in my bullish filters. Let's see if we can't find some stocks that let's skinny this filter down. Let's look at, I don't like to buy anything less than $5, so let's put greater than or equal to $5. I don't like to buy anything that doesn't trade a lot, so let's go 500,000 shares. And I like to trade options, but it turns out stocks that have options usually have more liquidity, so let's put at least a 1. And so that's going to take that list, and the list is going to get smaller. But I can do better, all right? I can do better because you notice here you've got everything is a bongo daily. Yes, that's great. That means that short term they're in uptrends. They're having big moves. But many of them, like Chevron, which may turn out to be a great buy here, by the way, are still have sold off weekly. Now I think this one switches to a weekly buy on next week, so that maybe is going to come back into contention. But Chevron does not look bad, but it does have a weekly, still a weekly sell-off. OLN, Olin Corp. Again, hard weekly sell-off. I don't like buying counter-trend rallies. I don't want to deal with all the overhead supply. So let's go down here and filter, and this is new. So not only can I filter for Bongo Daily Bullish and Bongo Weekly Bullish, I can come up here and say, I only want stocks whose Bongo Daily changed to green last week or the 5 days. So that list is going to get smaller. So now by definition, these are fresh changes. And what I taught earlier today in one of my training programs that I did was that when the weekly bongo is green and the daily bongo goes red, so here the weekly bongo is green and the daily bongo goes red, it identifies a pullback that's occurring in an uptrend, and this is considered an uptrend by the bongo. So here I'm looking at fresh switches, bullish dots, and I can make it even better. Let's look for stocks, and you have to be squeezing. So let's narrow this list down a lot. Could be too much, but let's see what we get. Apply. All right, so this is a list of stocks that meet those criteria. FIVN, okay? Stock was going sideways, was in a squeeze. This is a squeeze release, which means it came out of the squeeze on Friday. Massive volume, breakout, momentum. Look at the relative strength and OBV. Look how bullish the weekly chart is. FIVN is one that I might want to identify to watch. Neophotonics is a takeout. We don't care. Yum China. Yum China, kind of messy looking chart, was trying to run up, sold off, so you can see the sell-off here, the red bongo, in the setting of a longer-term uptrend and a breakout. Okay, I got to throw that in there as well. Adobe, here's one that looks really good. Now, the problem with Adobe is Adobe is sold off, so you're going to have lots of overhead supply, but you had a breakout on very big volume. Your relative strength and OBV are turning positive, and we talked about this earlier today, and we looked at buy point stops and targets. I'll put Adobe in my list. Cigna. Pull back in an uptrend. I would have liked to have found it back here, and by the way, I did, because all it took was the bongo signals and having at least one green dot or the EMS signal. So Cigna looks interesting. So the point here is that there are a lot of good-looking stocks in the market right now, and I've tried to narrow the list down to those stocks that are in a fresh uptrend. Now let's go back in here, let's narrow it even some more, and let's require an EMS signal. So now I could look at a list of curated stocks. A new one is MDB, and MDB is one that sold off, but is now in an uptrend. It had a breakout on volume from a squeeze on Friday, strong relative strength and OBV, and a new EMS signal. Okay, like that. UPS is one that popped up this week as well. And we can look at FedEx too. I don't think it's on this list. And you could see UPS had sold off hard, but it's already reversed, and it's now weekly bongo is green. And in the setting of that, you have multiple days of squeeze, green dots, and now squeeze release, and FedEx looks good. Could run into some resistance at that 200. Excuse me, this is UPS. FedEx, as a comparator, pull back to the 50, it just broke above the 200. This is probably a day or two ahead of UPS. This one also looks quite good. The problem with this one perhaps is it's already had a run, but this one looks great as well. Federal Express. Those are all on my bigger watch list that I'm going to be watching. Lululemon, I haven't looked at this one yet today. And Lululemon, you can tell it's sold off hard, but now it's turned the corner and the weekly's going up, and you flick the weekly bongo. This was a pullback in that uptrend, and now we're going again, not in a squeeze, which is why, actually, yeah, it's not in the squeeze. It's interesting. It says it's in the squeeze. Huh. All right, I give on that. It doesn't look like it's in the squeeze here, but you had the greenish dot and EMS signal and breaking out. So the whole point to me of scanners is to be able to look at the market, define your price and volume and options liquidity. Do you care if there's a squeeze or not? Let's turn off the squeeze and the release. I do only want bullish dots if I'm looking to go long. I'd like that bongo to have changed within 5, but you don't have to do that. And so this is kind of what I do every day. I open up the scan and I look for what stocks look interesting here. So hope you have an awesome week. I'm trying to shorten these. This is 33 minutes. On my Stocks and Docs site, it'll get down to 7 or 8 minutes. And we'll see you next week for the YouTube site. You all have an awesome week. Thanks.